now last week, basically, if you can't hear or see, please tell me. I think, as you know, last week we discussed the Basel III, the improvements to the capital and different capital components. Okay. So can anyone tell what are the new elements of capital that were introduced under Basel III and what are the percentages? Can anyone explain? What are the components of capital under new Basel III that were introduced and the minimum requirements? So I am talking of, international standards. I think we saw how we are applying in Sri Lanka, but when it was introduced internationally, what were the minimum requirements? Can anyone tell? That is for someone who was there last class. What are the key components and the minimum requirement? Of course, in Sri Lankan context, it will be somewhat higher than the minimum requirement introduced by the Basel. But international standards, what are the minimum requirements? Can anyone explain? No? Okay, let me ask, how much tier 1 you should have? Tier 1 capital. How much tier 1 capital? Okay. So the tier 1 capital is minimum 6%. Then within tier 1, there's a new element called common equity tier 1, which was required to maintain at a minimum level of 4.5%. Then total capital remain same as Basel 2, 8%. Okay. So basically the key change came from the tier 1 capital, which was enhanced from 4% earlier to 6%. But within that, again, there is another new component called common equity tier 1 and then additional tier 1. So common equity tier 1 to be maintained around minimum 4.5%. Then in addition, what were the things the Basel III introduced? Couple of new things, new elements. Can anyone? Okay, I think it's better you revise quickly because we will be finishing probably next, today or next week. So there were two buffers, additional buffers introduced, the capital conservation buffer and counter-cyclical capital buffer. So the capital conservation buffer is a permanent buffer, which is 2.5% of the common equity. The purpose is that to ensure capital is conserved or retained at good times to be used in bad times. So with that, the minimum capital requirement are further enhanced to meet the risks under the Basel III. Then counter-cyclical buffer, of course, if a particular bank does not meet the relevant requirement, minimum requirement as per the capital conservation buffer, with the capital conservation buffer, the banks are subject to certain restrictions such as payment of dividends, share buybacks, and there are other things which restricted until the bank reaches the relevant minimum capital levels, including the buffers, okay, conservation buffer. Then the next buffer is counter-cyclical capital buffer. This is not a permanent buffer, but the regulators or respective governments can introduce at national level to the banking system if need arises. From 0 up to 2.5%. So depend on the need, the maximum is 2.5%. The regulators can decide on what is the percentage between 0 and 2.5%. So usually it will be imposed at a time of high credit growth in the banking sector. So as you know, high credit growth means there could be possible recession subsequently, and end with a significant credit risk to the banking system as a result of probable NPLs going up. So those two were the additional buffers. So if you look at with the buffers, if regulators impose maximum capital countercyclical buffer 2.5% at such a time, the CET1 will rise to 9.5, Tier 1 rise to 11, and of course, total capital will rise to 13%. So there's a significant increase in capital, especially at a time of high credit growth, if the full buffer for the capital conservation is also introduced. Then this additional requirement called leverage ratio, I think all of you can remember, which is not a risk-based measure, based on a risk weights. It applies to the entire balance sheet on and off with the total assets of on and on balance sheet core capital or Tier 1 capital divided by total assets, not on a risk weighted basis. So that's again a measure introduced to maintain a leverage at a comfortable level. So the Tier 1 divided by total assets on and off should be more than equal 3%. So that's another requirement introduced in the Basel. Okay. So then I explained about how the Sri Lankan context started applying the original direction issued in 2016 with different elements based on the level of assets, that is DSIPs, domestically systemically important bank, and other banks below 500 billion assets, so that different ratios will apply. So we discussed all those in our last lecture. So let me quickly run through the computation part, in our context. So if you look at Common Equity Tier 1, you see the different elements that could be eligible under the Common Equity Tier 1. As you see, I am not going to explain each and every one. So equity capital or stated capital, assigned capital in the case of a foreign branch, the reserve fund, published retained earnings or accumulated retained losses, accumulated other comprehensive income, general and other reserves, unpublished current year profit or gains reflected in other comprehensive income, ordinary shares issued by consolidated banking and bank financial subsidiaries of the bank and held by third parties. Okay. So then there are other adjustments. I think you can remember I said the adjustments under Basel 1 and 2 mostly after the Tier 2 capital, but Now here the adjustments also come in after tier 1, common equity tier 1 capital. So which itself require more capital to be maintained in the form of CET1. So there are several adjustments highlighted. Okay, you don't have to remember each and every one, but remember these are the adjustments. So then you arrive at you come to the additional tier 1. So additional tier 1, as I explained, there are capital elements qualified under different criteria, so you can put those here. Then again, there may be certain adjustments under T1 which you need to incorporate here. Then you move on to the tier 2 capital. Again, tier 2 capital, there are qualifying tier 2 capital instrument which qualifies a particular criteria explained, which I didn't go into detail, but remember there are, I mean, you can't take each and every item for any of CT1, tier 1, additional tier 1, and the tier 2. So those are subject to qualifying requirements. And then, of course, again, here there are certain adjustments. Then you will arrive at you can arrive at total tier 1 capital and the total capital. So now let's look at how these risk weighted are computed. Remember, in Sri Lankan direction, the banks are required to follow the standardized approach. So I think we discuss on the standardized approach. What we do is we assign certain assets, the main assets, different risk ratings or credit ratings. So the risk weight is based on the credit rating. Remember, the Basel 1 and 2, the difference between Basel 1 and Basel 2 is the risk weight is based on the credit rating. So that will follow. So let me explain a little bit looking at this example. Now there are different elements now in terms of claims on central government and central bank of Sri Lanka. The central government's rupee claims on central government risk weight is 0. Foreign claims on central government, if there are foreign loans to central governments, then 20%, Central Bank of Sri Lanka 0%. So then look at the claims on foreign sovereigns and their central banks. Foreign sovereigns and central banks. Now, depending on the credit rating, you see the risk weight is different. Now, if you have lent to a foreign sovereign or central bank and the rating is AAA to AA minus, your risk weight is 0. Then if it is BB plus to B minus, risk weight is 100% and so on. Of course, you see B minus 150% and so on. So the important thing is the risk weight is linked to the risk rating. So let's have a look at another element. Now I'll move on to this slide, this part. Rupee exposures less than 3 months. Now, if you have lent to, if your bank has lent to another bank, but the exposure is less than 3 months due, then the rates apply is if the bank is the other bank is AAA to BB minus, the rate is 20%, BB plus to B minus 50%, below B minus 150 and so on. So based on the risk rating or the credit rating of the particular counterparty exposure, okay, then there are different risks. Now, for example, now here this is another category of assets, the exposures, the claims on official entities and multilateral development banks. Again, you see different risk weights apply based on the risk rating. So I'm not going to discuss each and every one. Now, for example, now if a bank has given to a corporate, how the ratings are applied, you see, claims on corporates, the corporate lending. So the AAA to AA minus, your risk weight is 20%. Now, BB minus risk weight is 150% and so on. So you have to assess, you have to ensure the right credit rating of the corporate and apply the risk weight. Now, this is what I said at the beginning of Basel 1. Now, irrespective of credit rating, the all depends on the security. If it is unsecured loan, you ignore the credit rating, so you apply 100%. But here it's different depending on the credit rating. Okay. Then there are other elements of exposures which applies different risk weights. For example, if you lend to SME secured on immovable property, then it's 60%. So net of security. Other SME exposures 75%. The individual exposures 75%. Okay. Likewise, now for example, claims secured by loan. Now, loan to value ratio equivalent to less. Now, if you have lent against loans, against gold, and the loan to value ratio is less than 70%, it's only zero weighted. So that means you don't have to keep capital. Okay. So this is the basic structure of standardized approach for credit risk. So this covers all balance sheet items and the relevant risk weights. Okay, certain exposures, of course, you can't have what you call risk grading, but certain exposures you have this grading based risk weight. Then off-balance sheet items, remember, now off-balance sheet items are not in the on-balance sheet. So you have a two-step process. Firstly, you have to use credit conversion factors to compute the equivalent off-balance sheet value. Okay. Now, for example, I think I'll take a common example now. Standby LCs related to particular transactions. Standby LCs related to particular transactions. Okay. Now, if you have 100 million standby LCs, now credit conversion factor is 50. That means your exposure is how much? 50 million. That 50 million, on that 50 million, you have to apply the relevant risk weight depending on the risk on balance sheet risk weights. Okay? So that's a two-step process. Remember, on balance sheet items, straight away you multiply by the risk weight. But off balance sheet items, it's a two-step process. Firstly, you have to use the credit conversion factor. It is given here for each element of your on balance sheet item. Multiply by that, convert into on balance sheet exposure, and apply the risk weight. Okay, depending on the risk category. So that's how off balance sheet items risk weighted are computed. So here given every possible, for example, shipping guarantees. Okay, now shipping guarantees conversion factor is 20%, on which you apply the risk weight. Now this is the conversion factor. This is not the risk weight. Okay, so each of exposure of guarantee. Now let's say you are given 500 million guarantee, shipping guarantee. So your exposure on balance sheet converted exposure is how much? 500 million multiplied by 20%. That is 100 million. On 100 million, let's say your guarantee has been given to a corporate with a AAA rating, then again your what you call risk weight is 20%. So that means ultimately your risk weighted asset value for this shipping guarantee is how much? 20 million, and so on. Okay. Then again, if you have exposures against securities, you can identify them here, like cash, government securities, provident fund balances, and so on, collateralized transactions, so that you can net off on balance sheet and other off balance sheet items. So this is okay. Let's move on to the market risk now. Market risk again, the Sri Lanka, they require you to follow the standardized approach. So the standardized approach again based on your long and short positions, and depending on the long and short position, there may be a couple of allowances for the computation, which I'm not going to discuss, but just to keep you informed: horizontal disallowance and vertical disallowance. For the interest rate risk, Then you can again compute the capital charge for general equity risk and specific equity risk. All the computation methodologies are given in the detection, and then you will arrive at the total risk-weighted amount for the market risk. Now, for the operational risk, you have to either follow standardized basic indicator approach or standardized approach or alternative standardized approach. Again, I think all of you know the basic, if you follow the basic indicator approach, it's just 15%. The gross income last 3 years multiplied by 15%. Or if you follow the standardized approach, there are 8 business lines. So you have different beta factors. So you have to take the gross income for each business line, average it and multiply by the relevant beta factor. Then if you follow the alternative standardized approach, then these are the elements, and so there are, in addition to the normal operations, there are the factors. Also, there are fixed factors, and then you can compute the what you call capital charge for the operational risk, depending on the method you follow. So all these sets the computation sheets. Okay. So once you compute the total risk weights, since you know the common equity tier 1, tier 1, and total capital, so you can compute the relevant ratios. Okay. So, so that's how the Basel III framework capital computation works in practice. Of course, if you ask your colleagues in your respective banks, who really do it, probably will come to know about this information. Okay. So with that, we conclude the Basel computations for different risks. So what I wanted to emphasize is the importance of Basel capital elements in terms of risk, how risk is aligned to the Basel framework, so which is again a very important element. Any questions before we move on to the next session? Any questions?
So there is a question.
Yeah.
Yeah. Once we do the credit equivalent of off-balance sheet items, how can we factor that to the computation?
No, what do you mean by how do you factor that to the computation?
That means certain risk weight is allocating according to this table. So is there a separate heading in our capital computation in the first one?
What you can do is now for example, let me say like this now. For example, take example of shipping guarantee. Okay. Now shipping guarantee. Take 200 million. Okay. Now you have exposure of 200 million shipping guarantee. Okay. So then if I go to this particular slide, can you all can you all see this presentation?
Yes.
Okay. Before I answer the question,
that is corporate governance and risk management slide.
Yeah. Can you see the big version? Full page, can you see?
Yes, we can see.
Yeah, can you see is it moving now?
Yes.
Okay. Okay, let me answer your
Yes.
question. Okay, let me answer your question. Now, take example of shipping guarantee. Now, shipping guarantee, I think we explained. Can you see this presentation? Can you see this slide?
Can see.
Okay.
Yes, sir.
Okay. Now, you see here shipping guarantees, the conversion factor is 20%. Okay. Now, assume your bank has granted a shipping guarantee worth 300 million to a corporate which has a credit rating of, let me think about something, a credit rating of A minus. Okay, credit rating of A minus. Okay, so the shipping guarantee exposure is 300 million. You have given the guarantee to a credit rating A minus company, corporate. So now shipping guarantee is off balance sheet item. So first you have to convert into on balance sheet exposure. So how do you convert into on balance sheet exposure? Using credit conversion factor. Okay. Now for a shipping guarantee, the regulator has said credit conversion factor is how much? 20%. So now this 300 million guarantee, what is your on balance sheet exposure? How much on balance sheet exposure?
300 million into 20%.
20%. Okay, so 300 million, 20%, 60 million. Now that is not the risk-weighted value. That is the on-balance sheet exposure. So that's why it says credit equivalent of balance sheet items. Okay, so this is the exposure. Now you have to look at the risk weight relevant to that exposure. Now this guarantee is given to a minus corporate. Now let me move. Okay. Now if you have given a loan to if you have exposure to a minus corporate, what is your risk weight? What is your risk weight? Huh? If you have
50%.
Huh?
50%.
50%. So your risk weight is 60 million into 50%. Okay. So that means how much risk-weighted assets for this shipping guarantee?
30 million.
30 million. So it's very simple. So you have to take your off-balance sheet exposure, multiply by the relevant credit conversion factor, convert into on-balance sheet exposure, and see how much, depending on the category of corporate or retail or whatever the exposure type on the on-balance sheet, apply the relevant risk weight. Now, for example, you have given this guarantee to a finance company, let's say financial institution with a AAA rating. You have given this shipping guarantee for a financial, same 300 million worth shipping guarantee to a financial institution with AAA rating. Okay, then how much your risk weight? How much your risk weight? Can anyone tell? 300 million worth shipping guarantee given to a AAA rated financial institution. How much the risk weight? Not the risk weighted asset value.
That is 20% of 60 million. That is 12 million.
12 million. Okay. So 300, the on balance sheet exposure is same because 300 million into 20%, that is the credit converted value 60. And the relevant risk weight, because you are given to a AAA rated financial institution, relevant risk weight is 20%. 20% of 60 is 12 million. So that's how these balance sheet exposures are computed. Okay. Is that answer your question?
Yes, sir. Thank you, sir.
Okay. Any more questions before we move on to this session?
So one more thing for the clarification.
Yeah.
If we have invested in a government treasury bill and we are hoping to keep that as a FVTP item that we pay for the trading purpose, for
I
which we need to get.
can you tell a little bit clear because there's a noise. Can you tell it again? I can't hear you properly.
Yeah, if we have invested in government securities.
Yeah, you have invested in government security, yes.
Yeah, then we are hoping to keep this asset as a trading purpose.
Trading purpose.
Yeah.
Okay.
Then we calculate the capital charge. We need to compute the capital charge for the market risk.
Yes. Now, if
Yes,
you
then,
two things here. Now, there's a credit risk element as well as a market risk element. Yes.
That's
Yeah.
what I am asking. We need to calculate the capital charge for market risk and credit risk separately. Is that correct?
Yeah, because the credit risk anyway zero because it's a government security, no. So credit risk component is anyway zero. Okay. Now, if you hold a government security, now credit risk element is anyway zero. Yeah. Anyway zero. Even exposure against central bank anyway zero. So you don't have any credit risk component, but only the market risk component. Yeah. Is that what you want to ask? Is that?
Yes, sir. If it is a foreign claim on central bank, then we have to set aside 20% credit risk exposure as well, no?
Yeah.
That is in addition to the market risk.
Yes, I mean, if you look at Sri Lankan context, there is no mark. I mean, generally you don't keep for trading purpose. I don't know if you have any foreign government securities used for trading purpose. So generally it's credit risk. In new case, foreign claims, but I rather doubt a bank having foreign government securities using for trading purpose. But if you have, of course, yes. Now here, don't misunderstand. Now this foreign claims is different to the foreign sovereigns. Huh? Now this is foreign claims means the Sri Lankan government claim in foreign currency. Huh? Don't mix up. Huh? But if you have a foreign sovereign, if you lend to a foreign sovereign, claim on foreign sovereign, depending on the credit rating, these are the risk weights. Now, this foreign claims means the claim on foreign. Now, for example, if you have a claim on Sri Lankan bond, foreign sovereign bond, then it's 20%. Okay. So here, yeah, so if you have a sovereign bond investment on Sri Lankan government, then credit risk weight is 20%. Then you have, if you are using for trading purpose, then definitely then you have to apply the market risk component as well. Is that right, or anything else?
So, at at the moment our ISP has been downgraded now. That therefore, if a bank has purchased that ISP, then based on that matrix, we have to set aside 150% exposure because it is triple C, no, less than triple B minus.
No, but this is in our case, it's 20%. Credit risk component is 20%. If you hold a Sri Lankan sovereign bond, your risk weight is 20%.
So then, if the same bond is held by the foreigner, then he has to set aside 150% exposure.
No, that depends on their risk weights. Now, this is Sri Lankan risk weights. Okay, let's say you have a bond, foreign overseas. I mean, Sri Lankan bank has invested in a foreign currency. So the bond issued by foreign currency in other country, then this risk weight is applied. Now, this is for your own country, you know, also central bank. Sorry, the Sri Lankan sovereign bond. So here risk weighting is ignored because you own bond 20% for the credit risk. Now these risk weights may be different in some other countries, but generally, so these are in line with the Basel, but there may be slight differences among different regulators. Okay, so they may not have the same. Like sometimes, you know, it may be higher. It may be you know, higher in certain countries, but it's more or less in line with the Basel requirement. Okay, so let's move on to the next area. Okay, the last topic for the you know, this program, and the corporate governance and risk management. So today we focus on how the two things link to each other: the importance of corporate governance in terms of risk management. So where we are going to look at what is corporate governance, what is risk management, how the relationship between two, and why is risk governance important, and what is consequence of failure, and what things we need to be put in place to ensure proper risk culture or risk governance framework in place. Okay. So there are many definitions to corporate governance, you know, in different countries, different institutions. So in general, corporate governance is a term that refers broadly to the rules, processes, or laws by which businesses are operated, regulated, and controlled. So it's the structures, the rules, policies, procedures, or laws by businesses are operated, regulated, and controlled. The governance code, there may be a number of governance codes for different categories of entities. Now, for example, maybe for the banks, there may be the regulator is imposing different governance codes, governance direction, but in general, there may be some, like Chartered Institute may have a different set of codes for the, you know, corporates under financial reporting. Sometimes relevant SEC or the CSC may come up with another set of governance code. Depending on the country, depending on the target group, there may be several types of governance codes applied in each country. A well-defined and enforced corporate governance provides a structure that works for the benefit of all stakeholders by ensuring that the enterprise adheres to accepted ethical standards and best practices as well as to formal laws. So if you have a good, well-defined governance structure, corporate governance structure, so that will work benefit for the all stakeholders. It's not just for the, you know, company itself, but all the stakeholders in the society, So by ensuring that enterprise adheres to accepted ethical standards and best practices. When we talk about governance, it's always we talk about ethical standards and best practices while complying to the formal law. So there are certain things which may not be in the law, but we follow certain standards, ethics, or the best practices. So there may be, as I mentioned, many more definitions for the corporate governance. Now this is something OECD introduced in April 1999, the system by which business corporations are directed and controlled, specifies the distribution of rights and responsibilities among different participants in the corporation, such as the board, managers, shareholders, and other stakeholders. So basically, well-defined corporate governance structure specifies the rights and responsibilities for each category of people in the society. To take corporate, the board, management, shareholders, and its other stakeholders like customers, the regulators, and so on. Then also spells out the rules and procedures for making decisions on corporate affairs, provides the structure through which the company objectives are set, and the means of attaining those objectives and monitoring performance. Okay. So it also provides structure for the setting of objectives and also monitoring of attaining those objectives. So in simple terms, the governance means what? Okay, few points I would like to highlight: doing the right things and doing the things right. Okay, so do the right things and doing things also right. Okay, so in other words, doing the right things for the organization and doing things the right way, independent of personal interest. So which covers the two aspects. We usually talk about conflict of interest. So whatever the thing you do the right way and also do right things. Okay, not the wrong things. Okay. So if you look at many failures around the bank, the institutions, not just the banks, even big corporates, if you analyze the situation, you feel you will find the major reason has corporate governance failures at the end, ultimate reason. So we could say it is the processes and systems by which a company is governed which ensure appropriate checks and balances. So you run the institution with appropriate checks and balances. It is essential to ensure good performance of the organization, proper accountability to all stakeholders, mitigation of conflict of interest. Okay, in a good governance structure, the people, boards, or another relevant people are responsible and accountable for all stakeholders for their actions. So when you talk about stakeholders, means customers, staff, shareholders, suppliers, regulators, communities. So all parties. So now in a general organization, it's whether a bank or a normal corporate, the top people are the shareholders who put in money to set up the business. Then the shareholders appoint a set of people called board of directors to run the business on behalf of the shareholders. Sometimes shareholders themselves would like to be part of the board. And the board of directors set the policy framework, governance structures to run the organization. And then under the board of directors, you have the managing director, sometimes executive directors, managing director and executive directors who are part of maybe board, sometimes not in the board, but they are the people selected by the management board to run the day-to-day business of the organization. and they design appropriate strategy to implement agreed policies. So basically, they are supports. So they are the people who are engaged in day-to-day operations, the executive directors, who take other measures to implement the decisions, the policies adopted by the board of directors. So as you know, under MD or the executive directors, there are other senior management team who really run the business plan, processes, procedures to execute strategies of the business. Now, when you talk about corporate governance, it's very important, the 4 pillars, very vital. If you break one pillar, then your whole structure could fail. The fairness, you are very fair in your transactions, dealings, the accountability. So you take your responsibility for whatever the things happen in the business. The independence, you are independent, okay, you take independent decisions, and the decisions are transparent, the actions are transparent, so that no one can put a finger on any entity or any individual. You have followed a very transparent process in any aspect of the business. So these are important 4 pillars: the fairness, accountability, the independence, the transparency. Now, when you talk about the elements of corporate governance, there are many elements, but if you look at major elements, the board commitment, okay? The commitment of boards is very important in terms of governance structures. Otherwise, there could be significant failures if the board itself does not commit to ensure good corporate governance culture within the organization. Good board practices, okay? So not only commitment, but there should be good board practices within the board. Functional and effective control environment, there should be good, effective internal control environment. The transparent disclosures, it's very important. You disclose whatever the important elements or important decisions of the business, including financials, in a transparent way, so that every stakeholder is aware of those things. The well-defined shareholder rights. Okay, well-defined shareholder rights is again very important. So now let's look at the risk management. I think already we discussed what is risk management. We started with saying risk management is the identification, assessment, and prioritization of risk. Now, as per the ISO 31000, it is defined as the effect of uncertainty on objectives, whether positive or negative, followed by coordinated and economical application of resources to minimize, monitor, and control the probability and or impact of unfortunate events, or to maximize the realization of opportunities. Okay. So how the two intersect? Okay. Now, here what is important is the governance and the risk culture. Okay. Now, if you take a company, whether it's a bank or any other corporate, must focus on achieving growth and profitability within appropriate risk control boundaries. I mean, so that is the important thing. So whatever the growth and profitability should be within the risk and control boundaries. Okay. So you have risk on one side, you expect return on one side. So in between, the important is the risk culture you bring into the institution. So which is basically the corporate governance culture. Okay. Now, the risk management is a part of group's risk function to probe, analyze, mitigate, and accept risk within agreed appetite and the boundaries. Okay. Then return depends on customer needs and financial objectives. Okay. So how you make a balance between these is purely managed through the risk culture you brought in to the institution. which is corporate governance. Now, corporate governance embed the risk culture into the institution. So basically, corporate governance monitoring and effective controls using a macro view of institution built around a shared cultural approach. Okay, so you know your need, you know the others' need. So you bring in risk culture in between so that you follow good practices, ethical standards to ensure achieve your objective while satisfying the needs of the other stakeholders. Now, what happens when there is a failure? So if you don't govern your institutions properly, then it leads to a significant failure. Okay, it leads to a significant failure. Now, so this slide I just want to highlight now what a hit on the economy and also loss to the economy due to crisis. Okay, so that's why these governance are very important. Okay, when there is a failure, it is not easy to recover from a failure, governance failure for several years. Sometimes even failures continue for number of years. You see, even in developed countries, the failures which started some time back has continued for number of years. And the fiscal cost is very significant. Okay. Now, if you look at this slide is about selected banking crisis around the world from 80s up to early 2000. Okay, so now take example, even high-income countries like Japan. The crisis which has taken place, the banking crisis in 1992 to 1998. It has moved to it has spread over 7-year period. And if you look at the reason has been the credit risk, 35% NPS, and if you look at the fiscal cost is 8% of the GDP, significant amount of fiscal cost. Okay, now take example of Korean crisis 97, again as a result of significant credit risk. And the fiscal cost is about 34% of the GDP, almost 1/3 of the entire GDP. Okay, so even if you move to other countries like for example, Indonesia, the crisis again as a result of high NPS, which has almost eroded the fiscal cost of about 50 to 55%, and the output loss again significant, and also which has led to the currency crisis as well. In certain countries, these banking crisis has ended up with a currency crisis. Now, for example, Korea, it has ended up with a currency crisis as well. The Argentina, the Ghana, then Indonesia, even in Mexico, the Thailand, Uruguay, and Venezuela. So these are few examples. The significant cost for a government, a country, as a result of banking crisis. So it's very important that you set your governance structures in place so that the possibility of a banking crisis is very minimum. So not like any other crisis, the banking crisis can lead to a real economic crisis. So that is the danger. So it may start, as you know, what happened in 2007. It started from a subprime crisis, then went to led to a banking crisis, and then to the real economy. It took more than 10 years in certain countries to overcome the situation, especially some European countries. So let's look at few examples of governance failures and crisis. I'm not going to discuss each and everything in detail. Most of you know about this crisis. The Enron, again due to governance failure. The WorldCom, Barings Bank, which is very common to us, very much known to us. Barings Bank, the Society General, Lehman Brothers, JP Morgan even had some problems. due to corporate governance, although it was not a significant issue. The Barclays Bank, the Royal Bank of Scotland, AMCON in Nigeria. So there are many examples in the world which created problems, sometimes including failures. Now, Enron, WorldCom, Barings, all failures, including failures and problems to some extent in certain other institutions as a result of corporate governance issues. Now, if you take Enron, again, it's a very it's global leading power and energy and utilities company. Now, they employed 20,000 staff and was A-rated before the crisis. Okay, and also it was one of the Fortune's top 100 companies to work for in America 2000. So it's a very highly respected top 100 companies that anyone would like to select to work in America. So the problem is the poor governance as a result of a creative account, manipulating of accounts, by the top team, including CEO, CFO. So how they have done it, they have placed liabilities in shell companies. So they have created shell companies and placed liabilities, and there aren't any books. So those are not appearing in the box. So basically their assets are overstated. There are again fraudulent deals, okay, which even auditors could not detect. The auditors were, I think, Arthur Andersen, and again, Arthur Andersen itself had problems and failed due to their failure to look or identify these problems. And basically, it's mainly corporate governance issues relevant to the key management, so which was bankrupt in 2001. So as a result, in US, there's a new act called Sarbanes-Oxley Act. Sarbanes-Oxley Act was enacted, which included several corporate governance rules, responsibility of directors, criminal penalties, etc. So this is a classic corporate governance. Briefly, I think if you get a chance, you can read through how these things happen, but it is we don't have time to discuss each and every case. But just to identify, the creative accounting, accounting gimmicks in simple terms has led to the failure. WorldCom, now WorldCom again, second largest telecom company in US after AT&T. Again, they were following a very aggressive growth strategy. And again, the growth strategy has gone to the extent with merging with another company, which was not approved by the regulators. Then again, financial records were not accurate. There were a lot of fraudulent financial records being prepared during the last 3 years before its collapse. Even changing the cost structures. Remember, there are different costs like recurrent cost and capital cost. So they have not identified, recurrent cost, but they have identified them as capital cost and deferred the cost. So as a result, they have shown overboosted revenues, and then finally, the internal auditors have recovered 3.8 billion worth of fraud, and sometimes even the auditors were responsible, they are external auditors. But at the end, the company became bankrupt in 2002. So you see that if you look at these names, they're leading names in the history, okay? Leading names, but ultimately probably their CEOs and the CFOs would have also be some prominent people, but ultimately, whatever the poor governance structures, practices followed has led to this situation. In now certain cases, they themselves have engaged in these practices, which has led the institution to a crisis. Lehman Brothers. Now, again, all of you have heard about Lehman Brothers, one of the largest investment bank in US, fourth largest, and very old, pretty old, founded in 1850. So they were just behind Goldman Sachs, Morgan Stanley, and Merrill Lynch. So it's the fourth largest US mortgage bank, investment bank. And so they were declared bankruptcy in September 2008 after the financial crisis. So there were drastic losses in stock and downgrade of assets by credit rating agencies, and largest bankruptcy in US history. So major reasons were financial accounting gimmicks. So they were fraudulent, accounting to show a better picture. And also they are engaged in the subprime mortgage bets, large positions in securities backed by lower rated mortgage. So as a result, in the first half of 2018, so they lost 73% of value as credit markets continued to tighten. So they had to sell $6 billion worth of assets and lost $2.8 billion. Okay, so it's a mammoth amount, which itself led to the closing down of Lehman Brothers. Then again another mortgage-backed security investment firm called Bear Stearns. Again, a little bit older company, 1993 founded, and also key important person there, the Louis Ranieri, father of mortgage securities. So as a result of financial crisis due to poor practices, governance structures, they had to incur significant losses. Then, of course, they sold their company to JP Morgan at a share value of $10, which was earlier $133. Okay. Barings Bank. Now, if you take Barings Bank, I think I explained the story when we did operational risk. Now, Barings Bank is the oldest merchant bank in London. Even famously known as even the Queen Elizabeth had an account in this particular bank. So founded in 1762, but collapsed in 1995, again as a result of poor governance structures, especially the operational risk issues. So loss from unauthorized speculative trades by its one and only one key head of derivatives called Mr. Nick Leeson. So as a result of there's losses in the Singapore subsidiary run by this particular person due to, again, accounting gimmicks and gambling on future direction of assets in the Japanese markets. So with the collapse of markets, he couldn't keep the positions open, and he needed to settle the dues to the stock exchanges. As a result, the head of his bank in UK became bankrupt. Okay, so there are a lot of internal control weakness in this particular case, which itself led to the failure of the institution. Société Générale, another bank in I think France. Jerome Kerviel, now the person who was in the trading business of the bank, his behavior of arbitraging between equity derivatives and cash equity prices resulted in a loss of trading loss of $6.1 billion US. So mammoth amount. So it's wiped up almost 2 years of pre-tax profits of Société Générale's investment banking unit. Okay, so the reason has been the taking unhedged positions far in excess of desk limits, up to 49.9 billion euros. Okay, so it was about above even the total bank's market capitalization. Okay, So there were a lot of fake hedges. So if you look at reasons, has been lack of risk experts on risk committees. So no one understood what is happening in terms of risk. So basically, due to the lack of knowledge, these smart people were able to convince the management or the committees that they are making profit while actually they are having problems. Okay, so this is the danger. So that's why in a good corporate governance culture, you need to have appropriate people, right people in right places. We will discuss them later. JP Morgan, losses on trading derivatives bet. Again, even this leading entity still surviving, but they had to run problems due to this, but they were able to recover from these due to their ability to sustain in terms of better balance sheet. So invest excess deposits to create interest rate hedges, brought in 4 billion over the last 3 years during the crisis. So estimates could reach as much as 6 billion to 9 billion versus Q1 profit of 5.4 billion. So the CEO Jamie Dimon under pressure. So pay off responsible officers to be docked, and ultimately somehow it was possible to bring the institution back to the normalcy. But these are leading institutions. Barclays again had some problems. The rate rigging scandal brought down CEO Bob Diamond, and so there's issue with rate riggings in the markets by the key people, so which led CEO also to be in trouble, and they were fine worth US $450 million, and also with criminal prosecution. Okay. So there's a division between investment and commercial banking. So the CEO lost $30 million worth of bonuses. So again, but was brought into normalcy after the findings. But actions were taken against the key management personnel, including CEO. RBS, Royal Bank of Scotland, again, there's a significant IT issue which broke down. So IT issue which led the failure of service to customers. Again, ultimately led to a problem with recording interest rates on LIBOR. As a result, there was a rate fixing scandal, which again caused some problems to the bank, and ultimately there were certain issues within the bank. So if you look at many such cases, these are few such cases, but you can find out many more cases related to corporate governance issues, which has led certain entities to fail, while which has led significant loss to certain entities, even though they did not fail. So now what we could do to ensure a good governance framework in place in our respective banks or respective institutions. And who can do this? Now, who is to save us? Okay. But if you look at these examples, one can argue, none of them have done their job. Okay. So is the board responsibility to ensure the governance framework in place? Is it the executive management responsibility? Or is it the internal audit who need to ensure the internal, through the audit process, that things are in place in the right way? Are the accounting firms? Okay, are they responsible? The rating agencies, have they looked at these facts before giving any rating? The regulators, have they looked in, for example, in the case of banks, have they looked into the bank's problems and identified their, risk and taken measures? So at the end, if one can argue, if you take different failures in different countries, someone can argue all have failed. Okay, so is it a failure of everybody? No, it may not. So, but everybody is responsible for not being able to detect these problems at an early stage to ensure or to avoid failure. So it's a responsibility of not just the board, not just the executive management or internal audit. So it's a failure of all parties so that right framework is in place, right governance structures are followed, and right monitoring mechanism is placed, right auditing is done by the audit firms, and also right evaluation by the rating agencies. So it's a duty of all parties. Now, so when it comes to risk governance, so each party has a role to play. In a corporate entity, the major role is under the board of directors. Okay, so they have to set the framework. Okay, they have to set the framework. So they are intervene in the running of operations of the bank. So what are their responsibilities? Select competent board members and establish guidelines to govern the board organization and structures. Okay, so now it's very important we look at again when we move on the presentation to have the right or competent board members. It's very important. You need to have the right people in place. So they have to establish guidelines to govern the board organization and structures. So they must set in a framework to manage the structure. Then select competent executive officers. So they must hire right people to run the business. And also it's very important to evaluate and compensate them accordingly. So you have to build a right compensation structure. Review and approve the management developed strategy. Review and approve the management developed strategy. Approve the overall risk appetite of the institution. That's very important. Managing the structure, the strategy or developing the strategy, and approve the overall risk appetite of the institution. Next is monitoring and the control environment. So it's very important the internal control framework of the bank and also monitor it. Okay, so ensure that the necessary corrective actions are taken to remedy the situation. So you have to ensure that, I mean, not just identifying the actions. If you feel there are certain improvements or corrections to be made, immediately take those actions. Ensure the compliance of the institution with its legal and regulatory requirements. Okay, ensure the compliance of the institution with its legal and regulatory. Always the compliance plays a greater role. So compliance is important in any one of the institution, especially with legal and regulatory requirements. And directors are to perform these functions in the best interest of the shareholders and other stakeholders. So they have to ensure they perform their duties and functions in the best interest of to the shareholders who appoint them and also to the other stakeholders. Okay. So now let's move on to the board of directors. Now, what is the role of board of directors? So now their role is assume responsibility of leadership and control of the corporate. Okay. So they have to assume the responsibility and leadership. So they must give leadership and control of the corporate. So they are the topmost people who are responsible for running the business, although they are not directly involved in day-to-day operations, set the framework and ensure the institution follow good governance structure. So direct and supervise the corporate affairs. So they have to direct and also supervise the affairs. They make decisions in the interest of corporates. So whatever the decisions they make should be in the interest of the corporate. Okay. Again, important to have regular meeting. Now, if you look at certain institutions, there aren't regular meetings. They don't meet regularly. They don't, set calendar for the meetings. It's very, poor risk culture. Okay, ad hoc meetings. No one knows what is happening. So these poor cultures, gives or pave the way for other people to run the organization in their own way and also engage in fraudulent activities. Active participation, it's very important, active participation, because even the regular meetings are conducted. Sometimes you see the certain members do not actively engage in the business. It's not good because you are supposed to express your views, ideas, thoughts, maybe positive, maybe negative, whatever way you want at a board meeting. So active participation is. Even in banking board, sometimes we see certain members, the contribution is very minimum. Okay. They come for the meetings, but they don't participate in the meetings. So participation actually is very important. Freedom to include items in the agenda. So they must have freedom to include whatever the items they feel comfortable in the agenda they wish. And another important thing is there must be sufficient notice for board meetings. Sometimes, the board members don't have any time to prepare for the board meeting, to read the board papers. If you conduct meetings without sufficient notice. So it's very important. Sufficient notice is given by the relevant people with respect to the conduct of board meetings. Access to advice and services of company secretary and independent professional advice. So if you feel you need to get professional advice, you can do so. And also advice of the company secretary is also important. The next, full record of board committees minutes, very important and available for inspection. Okay, it's very important. The board maintains the board minutes properly so that anybody can explain if you need access, if you need board minutes to see what has happened in the board, what decisions taken, who is responsible. That's very important, especially if there is an issue on the later date and then somebody can trace who is responsible and whether the board has acted in a prudent, ethical manner. Okay. Then independent, not executive director should be present at board meetings to discuss matters involving conflict of interest. Okay. So it's always important that the independent, non-executive directors present at board meetings, especially to discuss matters involving conflict of interest within the organization. If you look at the executive directors, they are people who are participating at, who are engaged in the day-to-day business activities of the company, so that there may be conflict of interest arising from their views, thoughts expressed at the board meeting. So it's very important, the non-executive directors to be present at all times to discuss such matters involving conflict of interest. Abstain from voting if conflict of interest exists. Always it is good that you may not vote, refrain from voting if you have any conflict of interest. Okay. Insurance, again, generally, if the board, if there are genuine actions by board, so there must be protection for genuine actions for any legal action against the board by way of insurance coverage. For any action done on good faith without any, malpractices. Chairman and CEO, okay. Okay. Now, again, it is very important in a good governance structure to identify the roles between the chairman and CEO. I think many institutions sometimes, because of this failure to define their roles clearly, has led to a lot of conflicts between the two, and also which has led to the problems in the institution. Okay. Now, so that's why it's very important identify what is the role the chairman need to play, what is the role the CEO need to play. Now, segregation of the management of the board and the day-to-day management of the corporate affairs is very important in that context. The balance of power at board level to avoid concentration of power in a single individual. So again, it's very important the power need to be balanced at the board level to avoid concentration of power in a single individual. Separation of chairman and CEO role. Okay, so what is the role of chairman? What is the role of CEO? Division of responsibilities between chairman and CEO clearly laid down in writing. So these are the things that you can avoid conflict of interest as a result of improper division of responsibilities between chairman and CEO. Sometimes we hear the news that the chairman also directly engaging activities of the institution. So that is not a good sign, because chairman is independent person from the business, operations. So that the direct involvement is not considered as a good sign or positive sign. So that's why it's very important identification of what is the role of the chairman and what is the role of the CEO in writing. Any questions so far? No? Okay. So now let's look at, so what is the role of the chairman? Okay. Now, if you look at chairman of a board, the chairman provides leadership to the board. Okay, so he's the key person who is taking the leadership role in the board functions. So he needs to ensure board works effectively and discharges its responsibilities, being the leader of the board. So ensure the board works effectively and discharges its responsibilities, and also ensure good corporate governance practices and procedures are in place. So it's his duty to ensure good corporate governance practices and procedures are in place. Okay. Ensure all directors are properly briefed on issues arising at board meetings. Okay. Ensure all directors are properly briefed on issues arising at board meetings. Responsible for ensuring appropriate information received by directors. So it's very important the directors receive the relevant information at the board meeting to discuss whatever the issues they want to discuss. And also the chairman is responsible to ensure the all directors are properly briefed on issues arising at the board meeting. Okay. So encourage full and active contribution to the board's affairs. So sometimes what happens in certain boards, chairman plays a key role while the others won't get any opportunity. Okay. So sometimes chairmen dominate. So that's not a good sign, because certain chairmen dominate means no one else talk. Okay. So no one else, others fear of talking. Okay. So that itself could lead to significant corporate governance issues, including unethical practices, behaviors, and leading even to final failures. So, so he must encourage all the other participants in the board to contribute to the board affairs. Okay. Ensure effective communication between board and the shareholders. So again, shareholders are the people at the middle who has put in money, and appointed people to the boards. So they must be also knowing, sure that they must also willing to know what is happening to their money invested. So there should be a effective communication between the board and the shareholders. Hold annual meetings with non-executive directors. Now it is important and also independent from the executive directors to have meetings with non-executive directors. Because if you look at executive directors, always have a conflict of interest because they are the people who may run the business. So they are actively engaged in day-to-day business. So probably whatever the discussion, points they raise have conflict of interest. So better you have, meetings with non-executive directors to discuss independent view of the organization problems, issues, and, matters. Ensure constructive relationships between executive and non-executive directors. So that's what I said. So you need to have a good constructive relationship between executive and non-executive directors, because the non-executive directors who are not part of running of the business, executive directors who are part of the running of the business. So have a clear dialogue so that to identify the problems and there won't be any gap. So this is the key role to be played by the chairman of the bank or the company. So let's move on to the board composition. Now, when you talk about board, it's very important to have a balanced skills of experience, skills and experiences. Now, if you have a board concentrated only to few skills or one skill, then probably you don't create a better dialogue within the board. Now, let's say even a bank board, if the board comprises of all bankers, that may also not good. Okay, they may be having a lot of banking skills experience, but they don't have other experiences. So let's have the board comprises of different skills, okay, different experience, okay, which is related to the overall business. Okay, so it's very important, to have people with different skills in board. Maybe in the case of a bank, with certain people with banking experience, certain people with accounting experience, maybe certain people with business knowledge, which is very important when the board take decision with respect to lending for different business, maybe certain people with law experience and so on. So it should be a mix of skills and experiences. The balanced composition of executive and non-executive directors. Now again, this is very important. You have a balance of executive and non-executive. Now, if you have too many non-executive directors, that again create problems because the idea of bringing thoughts of executive directors is limited. Okay, but if you have too many executive directors, then of course the independent decision making process is affected. So try to maintain a balance. Of course, with respect to the banking compositions, there are directions. Of course, if you can go through the corporate governance directions issued by the central bank, you will identify the exact numbers. So you can't appoint boards of directors at your wish. There are numbers, maximum number of people in a board, then the chairman's qualifications, then how many non-executive directors should be there, how many executive directors should be there, and also how many independent directors. Now, because of you are non-executive, you may not be independent. So it is vital to have independent directors also. Okay, because now non-executive does not mean you are not independent. You are not independent. Okay, so it's very important to have independent directors among the non-executive directors. So the non-executive director should be of sufficient caliber. Again, you must also, while you have a different skill experience, you must have sufficient knowledge in the area of banking as well. Independent non-executive directors should be expressly identified. So this is why I just mentioned So it's important that have a sizable number of independent non-executive directors. Non-independent non-executive directors are different from independent non-executive. But the independent means you don't have any attachment to the institution, so you can express anything. Now, even non-executive directors, you are not participating in regular functions of the company, but you have some attachment if you are non-independent. So independent means you are free to say anything. So because you don't have any attachment, interest in the company. So there are limitations with respect to those also in the Banking Act corporate governance directions. So that you need to maintain certain number of positions. But in general, if you don't have a limit for an industry, particular industry, so this is very important. The list of directors updated and their respective role and function identified. So you need to update the list of directors and also role and their functions to be identified. Okay. Now, again, it is very important to set the framework procedure for appointment, re-election, and removal of directors. Okay. So there are the few points I would like to highlight. There should be a very formal, transparent procedure for appointment. It should be very formal and very clear. So no one can point finger on any appointment to the board. Okay. And also there should be a succession plan. When a director retires, how the who will be going to be appointed as the next person. Okay. Maybe within the entity or maybe outside. Okay, so what is the succession plan? Okay, the re-election at regular intervals. Sometimes, in terms of company laws, you are supposed to re-elect after your elected period is over, and there is a procedure to be followed. So you must set the framework how the re-election of directors take place at regular intervals. Okay. Proper explanation for resignation removal of directors is very important. The right explanation is given if somebody is resigning from the board, or somebody was asked to resign from the board, or means the removal. So there must be clear explanation given so that no one misunderstand what happened for his resignation or removal, so that it is very transparent. So it's very important to have these things in mind with respect to your appointments, re-election and removal of directors. Again, specific term for non-executive directors. Now, if you look at non-executive directors, you must set a specific term. So this is the term you are going to serve in the way, maybe 2 years, maybe 3 years, maybe 5 years. Okay, subject to the relevant acts. Now, in the case of banks, there are certain rules which apply. Okay, so you have to comply with those rules. 9-year rule, the age 70 rule, and so on. So then the banks should comply with those rules as well in appointing or resigning directors. All directors subject to retirement by rotation at regular interval. So directors subject to retire by rotation every period, maybe 3 years, 4 years. The nomination committee formed to make recommendation on appointment of directors and succession planning for directors, chairman and CEO. It's very important to have a nomination committee to make recommendation on appointment of directors and succession planning for directors, chairman and the CEO, because then it's more independent and decision-making process when it comes to appointment and succession planning for the entire board, including the CEO. Any questions so far? So let me say this: in case of banks, there are different, much more stringent regulations will apply with respect to all this. Now, if you look at the integrated risk management direction, there's a risk management direction and the governance direction, which state different committees to be appointed, okay, in terms of the directions. So I'm not going to discuss all those here, but remember, in terms of corporate governance directions issued by the central bank, there are different other rules apply with respect to all these concepts we are talking today. I'm not going to discuss in detail each and every one, but these are very broad concepts from the point of risk governance, which entity should follow. Okay, so let's move on to the responsibilities of directors. Now, the directors are not just supposed to sit on the board. They also should keep abreast of the responsibilities as directors. What is happening? What they are supposed to do? What are their responsibilities? Okay. Sometimes you have seen in certain institutions. Now, of course, in the case of banks, now at least we have some directions in place. You must comply. So there is no way of the banks move away. Even if we move away, the regulators can find it. But maybe in certain institutions, I mean, directors are not, comfortable or keep abreast of their responsibilities. They just come for the meeting, sit, and just go. So sometimes even board meetings are, not conducted properly. Their views are not expressed by the relevant directors. And also exercise duties of care, skill, integrity, and diligence. So directors must, exercise extremely due care in taking decisions, and they must use their skills in certain things, and integrity and diligence. Okay, so these are very important when they perform their duties as directors of the board. Ensure proper understanding of the operations, business, and the regulatory environment. This is again important. Now, some director, now of course, the executive directors, they are in the business, they are implementing decisions, they are running the business, so they know each and everything happening in the business. But especially when it comes to the non-executive directors, there's a lack of understanding about the operations and the business. So the decisions they are going to take or decision they are going to implement may not be right if you don't understand properly the business operations. Okay, so they may have their own thoughts which may not be in line with the operations of the business operations or business and the regulatory environment of the company which it operates. So it's very important the board of directors aware of the broader operations and the business of the entity, so that their contribution may be effective. Okay, so otherwise they may not. Sometimes you have seen certain boards, because of the level of knowledge or lack of understanding, they don't take right decisions. Even the good decisions, the executive management required to do have been stopped by the boards when you have a problem boards with lack of understanding. Okay, so it's very important you have the right people. We will look at them later. Right people in place in the board, so that they have understanding of the business. At least they need they desire to learn. Okay, sometimes some board members desire to learn, but sometimes you see some board members, they don't have desire to learn either, and they don't want to contribute to the business operations. Contribute sufficient time and resource to serve the corporate. Now it's very important as a board member. Now, especially for now, if you take a bank, now you should now. Sometimes you see that board meetings are conducted very short periods. If some board members want to go for the other business operation, other business meetings. So it's very important that you have sufficient time and resources to spend at the board meeting and serve the corporate. Okay, so if you don't have that, I think it's better to avoid taking positions in a board. Now, In the case of banks, there are limitations of certain directors serving in other boards. Why it is been there is that to ensure the board member has sufficient time to engage in the bank's operations. Very important. If you have a lot of other engagements, you don't have time to serve in a board. Spend with the board sufficiently, then there will be a lot of risk. Now, let's say a board consists of 8 members. Let's say 4 of them don't have time to spend, or maybe even 5 of them. Then what happens? It's very difficult to conduct board meetings with sufficient coverage of issues, because they want to discuss issues very fast. They don't spend too much time, and ultimately the decisions taken may not be right. So it's very important. Always appoint members who can contribute, who have skills, and also time to spend at the board meeting to express their views. Also need to attend AGMs to share the views of shareholders. Okay, so the shareholders may have also views, with respect to the operations of the corporate or the bank. So attend AGMs. Okay, so it's very important. Okay, so that the shareholders' views can be also shared. Okay, any questions before we stop for a little break? It's almost 10:30. Any questions? Anything you need to clarify before we stop for the break? No? Okay. So if you don't have anything, we'll stop for a break. We'll start in like 20 minutes time. And probably we have a few more slides to go in this presentation. Hopefully with that, we conclude the session. And then probably next week, we will have if we have anything remaining from today's session, we will discuss that. And we will go for a, little bit revision series next week from the points which I discussed, and we will complete the program by next week. So if you have anything, any clarification, please be prepared with those for the next week. So we'll stop here for a break. We'll start in 20 minutes time. So what is the role of non-executive directors? Okay. So they must actively participate in board meetings because they have a greater role to play, because they are not engaging day-to-day functions of the bank. So they have a greater role to play at the board meetings, because they only come for the board meetings. They are non-executive. So they must express their views independently and also bring in independent judgment. So that's their view as opposed to the executive directors. And also they must lead the team if there is a conflict of interest arise. So naturally, the executive directors may have a conflict of directors when it comes to operational matters of the bank. So they must take the lead role so that they take care of conflict of interest. And also they must be able to serve on different committees of the bank. They must be able to serve on different committees of the bank, because they are independent, and they are non-executive. Okay. And also monitor the corporate's performance in achieving the preset goals. Okay. Now, another important point of governance structure is information accessed by directors. Now, this has been sometimes issued because the directors, of course, the executive directors have more information because they are involved in day-to-day operations of the bank. But the non-executive directors don't have access to information, which makes the process a little bit inefficient when it comes to decision making. So it's very important that all directors, especially the non-executive directors, are provided with adequate, appropriate information to make informed decisions and to discharge their responsibilities. Otherwise, lack of information may lead to improper decision making. Also, agenda and board papers should be sent in full in a timely manner to directors. Now, if you take non-executive directors, they are not full-time members, and also they may have other engagements in other respective institutions they work, so that they have other work also to be done. So, in order to get prepared for the board meeting and the board discussions, the board papers should be sent in full in a timely manner to directors. Now, generally, at least a few days before the meeting, they should get this information in full. If they don't get the information, probably they may not be able to have an active participation discussion while the board meeting is going on, and so probably they may not be able to contribute in full. So that's why it's very important the relevant board papers should be sent in full in a timely manner to the directors. Information supplied must be complete and reliable. So whatever the information supplied must be complete and also reliable, accurate. Director should have access to the senior management for information. If there is a necessity, director should be able to contact the senior management for any clarification or further information for their analysis. Information should be supplied of form and quality to facilitate informed decision. As I mentioned, they must be quality. I mean, the full set of information, complete, reliable, and of necessary quality. So let's move on to the remuneration of directors and senior management. This is again important area when it comes to corporate governance to avoid conflict of interest. So the remuneration policy of directors should be transparent. So everybody knows the process, how they are remunerated, and even certain things are disclosed under the annual reports with respect to the remuneration by way of standards. Remuneration should be sufficient but not excessive, and also important thing is for their active contribution and participation, there must be adequate remuneration paid. They are not full-time members, they only be compensated to participate at the board meetings generally, other than executive directors. So, and also it should not be excessive. So it should not be too much, but it should be comfortable remuneration. Each director not to involve in deciding his her own remuneration. So it is generally there may be a remuneration committee and they decide, but no one person should get involved in deciding his or her own remuneration. And yes, remuneration committee is to be formed mainly from non-executive directors, and so they will decide the committee comprised of non-executive directors, and maybe sometimes maybe MD decide on the remunerations of the relevant people, consult chairman, CEO if needed. Okay, access to professional advice, market comparable information. It's very important when fixing the remuneration to identify what is happening in the market and whether the comparable market remuneration are paid right now, and if there is a necessity to change it, I mean, it's important to change it. And also, if not possible to get market information, get proper professional advice so that right remuneration is fixed. Make recommendation on policy and structure of remuneration. Again, it's very important to make recommendation on policy and structure of remuneration. Determine specific remuneration packages of all executive directors and senior management. So it's a responsibility of remuneration committee not only to fixing the directors' remuneration, all executive directors and the senior management remuneration package, must be determined by the Remuneration Committee. So it is fair, process, so that no one can challenge the process. So, and it is independent. So it's under the Remuneration Committee, consists of mainly non-executive directors. So once it is said, it is very important to review and approve the performance-based remuneration, especially the executive directors and the senior management, whether the people have performed up to the standard, so that whether they are eligible for the same remuneration, or they need to be increased, or they need to be decreased, so that the relevant directors, executive directors, and especially the senior management conduct their work as per the expected standards. So that is very important, that reviewing process to maintain the remuneration at a right level. Review and approve compensation arrangement in connection with loss or termination of office, dismissal or removal of directors for misconduct. Another important thing is the compensation arrangement, setting up framework when somebody is asked to terminate the contract, maybe dismissal, removal of directors due to misconduct. So how the compensation arrangements are being done, in addition to what is available in the relevant laws. Relevant labor laws may set certain things when it comes to termination, dismissal, or removal of directors, but within the entity you can build another framework in addition, on top of the framework set by the labor rules in the particular country. Then, as I said, it's very important under the governance framework, accountability and audit of board and senior management for the affairs of the bank. So let's talk about financial reporting. The management provide explanation and information to the board to enable them to make informed assessment of financial and other information. It's very important, the provision of information related to the financial position, the bank stability, and other information relevant to the assessment with respect to the financial condition of the bank, and also reporting in the relevant public media. Board should present comprehensive assessment of the corporate's performance, position and prospects in annual and interim reports, price sensitive announcement, and other financial disclosures. So it's the responsibility of the board to assess comprehensively corporate performance, position and prospects in annual and interim reports. Most of them may be, or some of them may be disclosed to the public, and also especially price sensitive announcement and other financial disclosures. Then internal controls ensure the maintenance of sound and effective internal controls to safeguard assets. Now, this is again important element of a governance framework to have in place effective, sound and effective internal controls. Because it's very important, because now if you look at the operational risk element, one of the important operational risk element part is the internal controls. If you look at Basal definition, it's the risk arising from failures due to internal processes, systems, and employees and external events. So it's very important to have proper set of internal controls in place. So this is the second line of defense through the audit. They conduct regular reviews of effectiveness of internal control system covering financial, operational, compliance, and risk management control functions. So even though if you have set internal control framework in place, but you need to review them regularly to ensure whether those controls are adequate enough to cover the forthcoming risks, or maybe the new risks which arise in the different aspects of the business. Financial risk, operational risk, compliance, and risk management control functions. Again, internal control should be set in such a way, try to prevent fraud, corruption, and malpractices, so that things are in place. Now, if you look at the what you call Barings Bank collapse, it's a classic case of operational risk and internal control failure, the segregation of duties. Okay, so which led to the fraud, corruption, and malpractice. So that's very important. The right frameworking is placed in place to internal controls. So let's look at Audit Committee. So Audit Committee also has a greater role to play in terms of governance structures. So have a clear terms of reference, a formal and transparent arrangement to apply the financial reporting and internal control principles and maintain appropriate relationship with external auditors. Now, if you look at audit committees, are generally headed by non-executive directors with certain other outside members for the institution with expertise are also brought in generally with some background of accounting and audit. So it's very important they are given a set terms of reference. So what they are supposed to do in terms of governance structures. So a formal and transparent arrangement to apply the financial reporting and internal control principles and maintain appropriate relationship with external auditors. So when it comes to financial, because one of the key important element of audit committees are the financial reporting part. So so in doing so, there should be a clear relationship with the external auditors. Okay. So full minutes of audit committee to be kept. Okay. So it's very important audit committee keep full set of minutes, provided with sufficient resources to discharge its duties. So the relevant KMPs and this MD provide relevant information. Sometimes the audit committee directly reporting to the CEOs are generally directly reporting to the audit committee, or it's not CEO, the internal audit is directly reporting to the audit committee rather than going through the CEOs to ensure the transparency in the process. And again, it's very important the audit committee is independent from external auditors. Now, external auditors have one set of jobs, but they should be again independent from the external auditors, even though they use the external auditors' comments, views for their decision-making process. Now, they make the audit committee makes recommendation for appointment and removal for external auditors on a periodic basis, monitor the effectiveness of audit process, ensuring auditors' independence and objectivity. So they have a key role to play here. So they are supposed to monitor the effectiveness of audit process and ensure the auditor's independence and the objectivity. Also monitor the integrity of the financial disclosures. So they should, in addition to the external auditor's statement, they should look at them independently to ensure the integrity of financial disclosures. Okay. So oversight of the financial reporting and internal control process. Again, the audit committee is responsible for the oversight of the financial reporting procedures and also the internal control process. Now, as you know, now board cannot do all these functions, even so there could be delegation by board to certain categories of people, certain executive directors, okay, or certain KMS, certain tasks, okay. So, but it must be clearly scheduled, specifically reserved for board meetings, and clear instructions to management as to matters requiring board approval before decision is made. Okay, So when it comes to delegation, formal schedule of matters specifically reserved to the board for decision must be identified separately, and also clear directions to management as to matters requiring board approval before decision made. So there must be a clear differentiating between what needs to come to the board and what matters requires board approvals, and what things to be addressed at the institution level by the CEO and the other executive directors. So clear direction to the delegation of the management and administration function as well as the powers of the management. Okay, so board give directions, giving responsibilities clearly, what they are supposed to do, what the management is supposed to do in terms of certain decision making, and also administrative functions as well as the powers of the management. Review the arrangement for segregation of duties between board and management regularly. So have a process to review the arrangement for segregation of duties between board and management regularly. And also board committee to be formed with specific terms of reference as needed, if needed, to identify the delegation by the board. Okay. Communication with shareholders, important, effective communication. Because at the end of the day, even though board implement that framework and senior management and CEO run the business, ultimately shareholders puts the money to the business. So they are the ultimate equity holders of the business. So there must be effective communication with the shareholders to ensure they are provided with adequate information on the operations of the entity. So maintain ongoing dialogue with shareholders and make use of annual general meetings or other general meetings to communicate with shareholders. Generally, every year, companies are required to have the annual general meetings so that many things are discussed. There may be agenda items and also other general matters to be discussed with the shareholders. Okay, so especially important adequate time is allocated to discuss those matters with the shareholders. Transparency in corporate governance practices and business performance through proper and adequate disclosures. So there must be adequate and proper disclosures to ensure transparency in corporate governance practices and business performance, and also encourage shareholders' participation at the relevant meetings, if the general meetings and other meetings as required. Separate resolution for each separate issue. If you need certain resolution, rather than having one resolution, so for each resolution, for each issue, have a separate resolution. Because there may be different views by the same shareholders on different issues, so that they can express their views separately on separate issues. They may agree for certain issues, resolutions, but certain issues they may not agree. So rather than combining them, have one set of issues for one resolution, separation is very useful so that the shareholders express their independent view on each separate issue. Chairman of the board and chairman of each board committees to be present in general meetings to answer questions at but the discussions with shareholders are very limited to few meetings in a given year. Mainly many shareholders get together at the annual general meeting. So that is the main meeting, unless there's a EGM or something like that. So it's very important the key people who are running the organization at the top level participate at these meetings to answer any questions by the shareholders. The chairman and the chairman of the board and the chairman of each board committee, specifically, at least those people must be present Chairman of independent board committees to be present to answer any questions in any general meeting to approve transaction requiring independent shareholders approval. Because this is the only forum shareholders get opportunity to discuss their views, unless they themselves, major shareholders themselves being part of the director board. Communication with shareholders voting by poll. Now, sometimes there may be resolutions which require voting by poll, so that some shareholders may not be very thorough with these procedures. So ensure that shareholders are adequately informed about the procedures for voting by poll. And also ensure proper compliance to regulatory requirements about voting by poll. So there may be certain requirements when voting by poll. So please inform the procedures. Okay. Are there any questions? Okay. So if you don't have anything, let's move on to the have a look at the Basel corporate governance principles. Of course, now from the regulator's perspective, now Basel committee has set some principles with respect to the corporate governance. Okay, so I'm not going to discuss all this in detail, but just to highlight. Now, the different areas the Basel corporate governance principle address. So basically, 13 principles are in place by the Basel committee, and probably the regulators, when they implement the corporate governance rules for the respect to banking institutions, they consider all those things into the picture. So if you look at your corporate governance directions, so probably these are taken into consideration in certain places. So the principal one is the board's overall responsibilities. So there must be a clear framework in the bank stating the board's overall responsibilities. I think we discussed at the beginning what are their responsibilities, but then that must be in framework. The board qualification and composition. What should be the board the composition? How many members should be in the board? But of course, in the case of banking institution, the central bank has issued directions, the minimum and maximum board of directors, and also their qualifications and the composition. And also, if you recall, you can remember that when somebody is appointed to the board, there must be a test called fit and proper test. So not like normal institutions, in the case of banking institution, the directors should get the approval of the central bank to ensure they are fit and proper. So the framework is set in the corporate governance. So not everybody cannot be part and parcel of a board in a bank. So there are set of requirements that relevant statutes provide or disqualify certain person being members of the board. So they are supposed to evaluated under fit and proper criteria. And also there are age limits apply. Now there is a 9-year rule. More than 9 years you can't serve unless you are executive director. And also there's an age limit of 70 years apply. So there are many conditions in it comes to a banking institution. So the qualifications also set, what sort of people eligible to hold these positions in a banking institution. Sorry. Then banks' own structure and practices. So the different banks have different structures and also different practices, policies and procedures. So you must have your own structure and practices in place with respect to the governance cultures. The senior management, what are their responsibilities and so on under the governance structures. and also governance of group structures. If you are part of a whole group, how you structure the group transaction, relationships with the groups, related party exposures, and so on. Those are very important to set in the framework, so you know your whatever the transaction with the group companies are at the right level. Now, in terms of accounting standards, there are certain disclosures to be made with respect to the related parties and group structures. Then risk management function. So what is the broad risk management function you adopt in the bank? And what is the risk identification, monitoring and controlling mechanism set in place? Risk communication. So those are related to the risk element, the risk governance. So you must set the framework in terms of your principles in the risk governance framework. The compliance, again, how do you, if you look at the banks, there are requirements to appoint a compliance officer. Chief Compliance Officer, the person is responsible to ensuring the compliance of all internal and external requirements, including relevant rules, regulation, and roles. So that is a requirement for banks. But maybe in certain other institutions also there may be a compliance function, and what is his role, what he's supposed to do, and his independence also important. Then internal audit. So what is the internal audit process and the independence of the internal audit, the audit plan, audit universe, and there are so many things that you will capture under the internal audit under principle 10 of the governance principles. Compensation. Now these things are this will be discussed earlier. So the compensation mechanism, the relevant remunerations committees, the transparency in the process, and also the compensation with respect to the removal, dismissal of directors, and so on. So that is inbuilt into the governance framework. Disclosure and transparency. This again we discussed. It's very important. The relevant the board take responsibility to disclose relevant information, financials to the public and the stakeholders, and also transparency in the process, including operations of the bank, so that the stakeholders can take well-informed decisions. The last principle says the role of the supervisors need to play. So in addition to the bank, there are some roles to be played, role to be played by the supervisors. The supervisors, in terms of that only, supervisors issues governance directions and conduct their monitoring regular basis to ensure the banks adopt good governance practices and best practices. And if there are any deviations from accepted practices, the regulators impose certain restrictions or certain conditions on those banks. So broadly, these are the 13 principles set by the Basel Committee on Corporate Governance. Any issue, any concern? Okay, so let's look at few matters related to governance issues. So these are the experiences we gain from real governance related failures. Okay, so if you analyze the governance related failures around the world, you see these are some of the issues which has led to the failures of those institutions or probable failures. So firstly, the risky business models. Okay, now I think overall all banks prepare their strategic plans, medium-term or long-term strategic plan, and conduct business as per those strategic plans and the business model. With business models of different banks may be different based on the risk appetite, risk tolerance, and the expertise you have in your bank. So now sometimes you see now In fact, the banks are operating in a very tight competitive environment. Okay, very tight competitive environment. Sometimes, in order to maintain your business at a particular level, you may sometimes require to adopt risky business model. You may adopt it. So sometimes you don't have very big knowledge in it, but you adopt a risky business model. But later on the day, you will find you have ended up with some disaster. So if you look at certain excessive or aggressive growth strategies followed by banks in certain periods have led the bank to fail subsequently. Then fitness and propriety of directors and key executives is very important. You pick the right people as directors. The fitness and propriety, now as I mentioned earlier, in the case of banking institutions, there are directions which says who is right, who is fit and proper, and to be approved by the regulator. Then key executives. Now again, I think the direction covers that as well. Key executives also must be people with fitness and propriety. So if you don't have the right people, then of course they may not conduct the business properly and maybe lead into the problems. Poor compliance function. Okay, so that's again a governance issue, not being able to comply with the internal, not just the external rules and regulations, but internal rules and regulations, not following the limits, not following the relevant procedure, deviations from procedure. So only those lead to subsequent issues and even sometimes failures. Another important element is high exposure to related parties. So now, when it comes to related parties, it's very important now. I think I mentioned here the group structures, governance of group structures. Now, related parties means your related groups, entities, and your own related individuals. So it's very difficult when a bank has high exposure to related parties to, especially in terms of credit, to recover at a difficult period from the related party, because the people are reluctant to engage or dialogue with the related parties, and also the related institution may itself go into problems, so which make it difficult for the parent entity to cover up their losses as a result of related party failures. So it's very important to maintain related party lending at acceptable level, and also there are some regulations with respect to the related parties or individuals. So ensure you adopt the right strategy. But of course, if you have high exposure, then of course it's a possible indicator of a governance issue and a problem. Non-availability or dormancy of board and senior management. So I mentioned that it's very important to have the board meetings on a regular basis, and also the effective participation of board members at the board meeting. Sometimes even the boards are there, but board meetings are not conducted regularly, and there is no effective participation. And also sometimes you don't see the full board members are there at the board, because once a board member resigns, those vacancies are not filled on time. So the boards are run with few members, so that it may be very biased towards certain decision making. So also management committees. Sometimes the management committees may not be there, or even if the committees are there, they are participation or conduct of meeting is very poor. Regulatory arbitrage to related companies, that's again another weakness area, which has created many problems in certain group-related banks and other entities. Because now when you have many number of institutions within a group, you can easily try to overcome certain regulatory restrictions through dealing with other companies in the group. See, for example, you have a related party arm, which your bank cannot directly lend to that particular arm, but you may lend to a particular arm which is not prohibited, and that firm may lend to the other firm which you can't directly lend. So that's a danger. That's called regulatory arbitrage. And again, if you still if you are still part of a group structure, very important to ensure regulatory arbitrage is not done. And if you do, that's a clear sign of a governance issue and also future risk. Dominant CEO and concentration of power among few key management personnel. Now, that's again a classic example of certain institution failures. This is not just in Sri Lanka, but in many countries this has been experienced. Now, certain CEOs are very dominant, and also even certain chairmen are very dominant, and the concentration of power among two key management personnel. So this is a very dangerous sign. If you see CEO run the full organization, he doesn't get advice of, or even he doesn't care what the other KMPs are doing. He doesn't listen. He does what he wants. So means dominant. Okay. Sometimes he directs people to do this thing, whether right or wrong. So people sometimes carry those directions without knowing the particular risk involved. Even in your organization, when you see your CEO is dominant, that's a clear sign of risk, possible potential risk in the future. So no one's scared of talking against the CEO. It's like hire and fire. Sometimes even he tends to fire certain people if they don't carry out their directions. So, but in the world, it has been many failures. I'm not going to discuss individually. So, in certain failures, it's a clear problem with dominant CEO and concentration of power among few key management personnel. Excessive remuneration to senior management, again, too much remuneration. Okay. Sometimes it's a governance issue compared to the accepted level. Again, one problem has been concentrated family ownership. So this is again a critical issue. Now, when the business is run with a few shareholders, with a few family concentration, it's very difficult. But of course, in Sri Lanka and many places now, we have ownership guidelines. In the case of banks, the maximum single person can own is 10%. If it is going beyond 10%, you need to take approval, but again subject to a limit of 15% and certain cases 20%. So at least the concentration is not there in the case of banks due to the rules and regulation imposed by the regulators. But now take example of finance companies, but at the moment there was no limit, but already there's a direction which has issued to bring down the ownership. But at this moment, there was no limit on the ownership up to now, so that even one person can own 100%. So the concentration is very important, but in the case of banks now it has been addressed to a great extent with limits imposed. But if you look at the entities with higher concentration and family ownership, again very poor governance structures could lead to problems in companies later. Absence of policies and procedures, that's again important. Poor conduct of board meetings. So I have repeatedly mentioned the importance of effective conduct of board meetings, effective participation, and effective discussion process, so that matters are discussed among all members, so that the right decisions are taken. There are no biases in the decisions, and everybody's views are listened by every member, and opportunities given to express their views. So it's very important to have a proper meeting. But of course, if you have poor conduct, where the members are not coming to the meetings regularly and all meetings are not conducted, and also not much discussion, and also opportunity is not given to the people to discuss, then of course it will lead to big problems. Absence of policies and procedures. So it's a very important that the board, the governance framework should set relevant policies and procedures to be implemented by the executive directors and the senior management. So now sometimes institution does not have clear policies and procedures. Now, for example, in case of credit, it's very important to have a framework. So I think I discussed in brief when I discuss about market risk element, sorry, risk management in brief. What are the policies relevant to different types of risk? So that it's very important to have a policy framework in place. How, what, in simple terms, it's like what sectors you lend, what are your target group, what securities you adopt, how do you do the risk assessment, and so on. So this is the basic policy framework. What is your pricing policy, and how approvals are obtained. Now, for example, there are limits, authority limits at each level. In the case of a smaller level, who is the authority and who can, how much he can approve. When it comes to big loan, what is the authority and how those can be approved, what securities could be obtained. So there must be a clear policy framework. Now, if you don't have anything, then no one knows what exactly to do. So everybody does what he thinks right, he or she thinks. So even leading to high exposures or favorism, or maybe malpractices. So it's very important to have a clear framework. So if you look at many problems that has taken place around the world, this has been also identified one of the possible governance issue related in those problems. Absence of succession planning, that's again a very important thing. Now, when somebody moves out or somebody retires or somebody resigns, who is going to take over the position? At least the special positions, key positions. So that there is no vacuum created as a result of the people retiring, people leaving the business. Otherwise, there may be some, problems. Suddenly, somebody retires, he dominates. So that you should not allow anybody to dominate. Now, this is how some people, demand things from the institution. So when the people know, when the KMPs know, there is no succession, so they do whatever they do. So the bank rely on these people too much. So even if something goes wrong, the management would be reluctant to, remove that person because the lack of proper succession planning. So which create a vacuum and also problems later on. So absence of succession planning is also key governance issue. Absence of clear reporting lines, you must set the framework so that you exactly know what is your reporting lines are. So there are no miscommunication. You go through, you follow the path so that you follow the relevant authority, so everyone knows what to do. So there won't be any manipulations or malpractices as a result of reporting lines. So, but if you don't have, then that's a clear signal for a governance-related issue. Then inadequate internal controls. I think we discussed the importance of internal controls in details, the failure of internal controls, the segregation of duties, which will definitely lead to the, now classic example is in the case of banking sector, the balance bank, lack of internal controls, segregation of duties. Then absence of an independent internal audit. So there must be a very independent internal audit. Okay, if you don't have a proper independent internal audit, there is no way of monitoring checks and balances. So it's very important. So it must be taken as a good internal control within the entities. The second defense of risk management, second line of defense. The poor MIS. Now again, what is MIS? Management Information Systems. Now, in order to the board or the KMPs to know what is happening, the MD to know what is happening, there must be a very good MIS providing accurate, reliable information. So if you don't have a very good MIS, that itself lead to problems because you can't make right decisions. Now let's say, now take example of a bank. Now suddenly the bank is running into little bit tight liquidity situation. So bank needs to find out, okay, now let's say bank is spread all over the country with 300 branches, where you need to know at a given point of time how much liquidity you have, how much, let's say, cash you have in your hand. So there must be a proper mechanism that you can accessible within few minutes, hours. So what happened if not? Okay, if not, what happened? Then probably, or if even if you get the information, if it is not reliable, okay, let's say you in fact have little liquidity in terms of cash, but the report, due to whatever the problems in your MIS system, MIS says, okay, you have adequate liquidity or cash. So you depend on wrong information and take a decision. Then what happens? But reality, your decision is wrong, or decision cannot be implemented because of the wrong information. So then you may run into problems. So it's very important information is reliable, accurate, and very fast. At least the key information should be readily available at any given moment of time. Okay, at least key information, especially a bank with a large number of branches. Okay, so the management information systems provide greater, need to play a greater role in terms of provision of information. Let's say your chairman asks, want to know about risk related to certain areas of your borrowers. Okay, so you must be able to, system should be able to generate a report within, short period, so that he can, have a look at and come to idea of the problem area. So when you have poor MIS, poor means the information system itself cannot generate the required information. Secondly, the information are not reliable or accurate. Then that will lead to a significant risk. So ensure the banks have their, core banking and other MIS systems in a right way, so that decision is very fast. So that the information should be linked to all the other, different, management. I mean, this is not just the management information, even like your ledgers and all, accounting systems must be linked to the main system, so that even those information can be, captured in a short period. Risk management function, so this has been repeatedly discussed within this course. Poor risk management itself can lead to disaster situation of any organization, especially in the bank. The banks are subject to many more risks. So if you look at these areas, if you pay your attention to these areas, if you have any problems in these areas or concerns, so two things you can do. One thing, it is a signal of a potential risk, potential threat, or possible failure. So the second thing is you must take action immediately. Okay, must take action immediately to rectify those concerns, so that you can minimize risk of such problem or failure. Any questions? Anything you need to clarify? Okay. So now let's look at the necessity to restore risk management culture within the entity. Now, the important things are, now if you look at the risk culture of an organization, it stems from this leadership. Now, the leadership, the board and the chairman, board and the top management should take the leadership to bringing a risk culture to organization. If the board is to understand, define, and actively manage its organization's risk appetite, it needs a core of executive directors with solid business and risk appetite. Sorry, expertise. Okay. So in that context, it's very important the board understand the risk appetite of the organization and manage it properly. And to do so, there is a need for core of right people, right talent of executive directors with solid business and risk expertise. So otherwise, if you have people with less appetite or less understanding of the business and expertise, then of course there could be a lot of issues. Board members must not only be informed but also understand the risk return drivers inherent in major product innovations and concentration. Not only the executive directors but even other board members also understand of the risk return drivers. So they must have also basic understanding, especially in the major product innovations and concentrations. Now, this is very important when it comes to new products and services offered by banks, also hiring some new systems to the bank, where ultimately boards are the ones which approve those final, which make the final decision. So the relevant approvals are given by the board, so that in order to do so, they have a clear understanding of risk return drivers. Let's say whether this product is giving the right return in terms of the risk it envisaged. Board must also understand Board must also understand and accept the consequence of major implementation decisions. So they should understand, okay, if this is implemented, what is going to happen? Okay, what could be the consequences, the positive, negative, and see whether we are taking the right decision, we are giving the right approval. But otherwise, later on the day, no one could blame. So later on the day, no one can say, okay, I didn't understand, I approved it. I thought it was good project, it was a good proposal. But if I knew this was I would have not given. So that's not the way that board should act, and also within a strong risk management culture. So that's why I said at the beginning, in the composition of the board, you must have a core of executive and non-executive directors with right skills and experience. That's very important. So they have to understand they should not just take decisions as they feel. Okay. So in overall, the risk management culture is very important. Strong risk management culture, so that it is inbuilt into the governance framework, so that the risks are understood properly, risks are understood properly and managed properly, and the boards take appropriate decisions within its risk culture framework. Okay, so let's look at some corporate governance related failures. I have just extracted from particular article written by these parties. Now they have highlighted 8 cases, not just banks. It may not necessarily banks, but certain corporates. What is the cause of failure? The governance failure. The Enron, it's a US company. I think I discussed a little bit in detail earlier. So the observable cause of failure is inflated earnings manipulations, a governance issue. The internal audit has failed, so no one has looked into these things. WorldCom expenses booked as capital expenditure, so that again earnings are inflated. So no one, even CFO, has engaged in poor practices. No one has been able to check those things. The Tyco, again, looting by CEO, improper share deals, you see, the improper management by the CEO, and also he himself has engaged in fraudulent deals due to maybe lack of controls. The Global Crossing, again, US company, inflated corporate profits to defraud investors, so that people would be happy. Maybe the dividends have been declared, even though they don't have any profits. Royal Ahold Netherlands, earnings overstated, and a governance issue. Manipulation in the financial reporting. Pamlet, Italian company, false transactions recorded. No one could trace it. Again, control weakness. Walmart, USA, weaknesses in internal controls have led to government investigations and class action lawsuits by employees. So that's the internal control in failure. Okay. The Xerox, accelerated revenue issues. So all these entities have run into problems. Some have maybe intrant Worldcom mode failures, which arises due to what you call which arises due to the what you called governance issues. Okay, so that's very important for us to identify the governance structures so that there won't be any possible failures in the relevant institutions. So with that, we conclude governance sessions. So I will go through the case study of Ceylon Bank, I think, which happened in late 2008. I think some of you who have been in the field of banking that time, you know, but others will come to understanding. You know, Ceylon Bank was about to fail in late 2018. There's a significant failure, and there's a quick revival involving central bank within a couple of hours to avoid the failure, and so it was revived. So I am going to highlight a few key important things why the bank went to that status. So this was extracted from the annual report they prepared for year 2009. The annual report itself says the case study Ceylon Bank. If you have a chance to read it from your colleagues so that you will have a full set of details. I will just pick some points and I will explain the importance of risk management and risk indicators so that you know that possible failure, or so that you can take measures early. So before we move on to that, are there any other questions from governance session? Okay. So let's go to the case. These are extracted from that book, published book, in the sense that's the annual report, not like a traditional annual report. It's a like small book which contain annual report and the analysis, the subsequent board done in that annual report. So all these are extracted from that book. So these are not my words, that are directly extracted from that book, so that you can also read to see in detail. So I have taken a summary of that. Let's go through now. If you look at in December 2008, those who were there in the Ceylon Bank or any other bank would know, the Ceylon Bank was confronted by a sudden, unexpected crisis of public confidence. Okay, so severe loss of confidence as a result of failure in certain company in the Cyclical group. So which led the loss people to lose confidence. In a banking business, one of the most important things is to maintain public confidence. It will take only a few seconds for bank to fail if you lose the confidence. So again, so this is what happened to the Ceylon Bank. So there's less public confidence. The people started withdrawing money. The liquidity went short. So the situation facing Sri Lanka's fifth largest bank, at that time Ceylon appears to be the fifth largest bank, while no doubt linked to the widespread uncertainty in the wake of the global economic downturn, was triggered by a highly publicized financial collapse much closer to home. Okay, so this was the fifth largest bank among 30-odd banks. If it failed, would have created a significant systemic crisis, and leading to even a significant economic crisis. So as a result, many concerned customers rushed to withdraw their deposits, creating a run on the bank. So the people rushed to the bank to withdraw their deposit, thinking the bank would going to go bust. Okay, so even you and me, if come to know that some particular bank is going to go down, we will immediately go to the bank and try to withdraw money. So all over the bank, there's a big rush to take the cash. As from their deposits. So it was created a significant threat to the stability, so that the ensuring period of instability threatened the very future of a 20-year-old bank. So it was almost 20 years later this happened. So the bank started its business, I think, 1988. So 2008 means it's 20 years. So it was a significant lesson for all of us to ensure your banks run with proper risk management, governance structures, so that these things won't take place in your respective banks. So the book itself has highlighted the reasons behind this crisis. Okay, and it says the crises are complex. Okay, so let's look at what the book says. The Ceylon Bank was founded in 1987 and opened its doors for business on 24th March 88 in Colombo Fort. From its founding, the new institution was part of Cyclical group of companies, a major Sri Lankan conglomerate operating in a wide range of industries. Okay, so it was part of Cyclical group led by Mr. Patalavan. And it's a part of large conglomerate of the Cyclical group. Rapid profitable growth. Okay, the Ceylon Bank enjoyed immediate success, reporting after-tax profit of 11.3 million for the first partial year, that is year ending 31st December 1988. So it started with a profit of 11.3 million. Over the next 17 years, the bank grew at an unprecedented pace, with assets totaling 113.6 billion by the end of 2005. So by the end of 2005, the assets have grown to a massive 113.6 billion. Profits in the same period fluctuated to some degree, but followed the same overall rapid trajectory. So even though profit, fluctuated, but the growth was enormous, reaching 687 million after-tax profit in the year 2005. So assets grown to 113.6 billion. The profits risen to after-tax profit risen to 687. It's a massive, profit. The other key measures showed a similar pattern of dramatic growth. So other measures show that dramatic growth. The bank's workforce increased steadily from an original staff of 72 to a company-wide total of 3,733. So it started operations with a 72 staff, grown up to 3,733. The single head office location grew into a network of 117 outlets based from 1997 onward in a new headquarters Cyclical Ceylon Towers. By 2005, Ceylon Bank was the fifth largest bank in Sri Lanka and ranked third among privately owned financial institutions. So it's the fifth largest bank and third among the private banks. Okay, third among the private banks. Now this is the important thing. So what are the key things which led to the failure? Failure in the sense almost collapse, which were revived. Overexpansion carries a price. In the view of some stakeholders, the staggering growth achieved by Ceylon Bank had led to a classic case of overtrading. So remember, when you overtrade your business or you are expanding beyond your business, what does it mean? You are creating additional risk unless it is supported by the capital. So any bank should not grow if it is not supported by capital. Over expansion. The banking is by definition a capital intensive business. However, in the case of Ceylon Bank, aggressive expansion both in terms of business volumes as well as physical infrastructure. Now, what do you mean by physical infrastructure? Opening branches, expanding the ATM network, building new premises, etc., had exerted tremendous pressure on the limited amount of capital available. Okay. So the way it expanded in terms of even business volumes and physical infrastructure, branches opening, ATM network, new premises, which led enormous pressure on capital expenditure. So they had little to do other business. Or even this capital expansion may not bring in, good revenue in the future. Within 5 years of bank's foundings from 1988, its gearing ratio, now gearing is the leverage, all of you know. Degree of leverage required to finance operations calculated as total assets divided by total shareholders fund shot up past 39 times. So within 5 years, it shot 29 times. So this pointed to serious problems. When you see this, that is indication of problems. The ratio, in fact, remained extraordinarily high through the rest of the 1990s and beyond. So even after that, ratio was kept little high, where other industry players typically hold the gearing ratio below the threshold of 15 times. So when the others are maintaining it below 15 times, Ceylon Bank could never maintain it below 20 times. So even it has shot up to 29, but it has never been able to bring it below 20 times. And in many years, it rose significantly higher. It's not just 20, but many years it was very high. So now if you take 29 times, means almost double the other players. More than double. So that is a clear indication of risk, overexpansion. In retrospect, one need only glance at the bank's financial performance highlights from early 1990s onward to confirm a long-standing gap between business needs and available resources. So as a result, there has been a gap between business needs and available resources. Okay. The capital adequacy ratio, which had been consistently forced downward as growth in capital failed to keep pace with the growth in the volume business. Now, the capital adequacy ratio has always been downward trend because the growth in asset is not supported by the growth in capital. The beginning in 1993, the year it was first reported, this vital ratio was frequently below and never more than marginally above the required statutory minimum of 8% and 10%, 8 to 10% at the tier 1 and tier 2 level. So since this ratio began to report in 1993 in Sri Lanka, the banks was marginally above or sometimes below. So that itself says bank cannot manage its economic capital. Even the regulatory capital sometimes below or marginally above. Other warning signs. Ceylon Bank cost to income ratio was highest in the industry. Significantly high. To take the industry, it is highest. So this is the story told by the subsequent management. It's not just somebody else telling. The board appointed subsequent to the crisis. Its ratio of non-performing loans ranging from just over 11% to more than 18% since reporting began in 1990, and was similarly among the highest in the industry. So even the NPL ratio was highest. So that's a significant indicator of credit risk. So it was the highest. So the Ceylon Bank has been the highest credit risk in terms of NPLs. In addition to shortfall in capital adequacy, there were other areas where the bank failed to comply with minimum statutory requirements. So there have been, in addition to the capital, because there are other areas. The Ceylon Bank was half the size of the country's largest private banks in terms of asset, yet it employed virtually the same number of staff. So what does it mean? At that time, it was half the size of the largest private bank. Say the largest private bank had 100 billion asset, the Ceylon had only 50 billion. But both banks have same number of employees. So what does it mean? Inefficient use of resources and high operational costs. So when the largest bank had, let's say, 1,000 employees, this is half of this. The Ceylon Bank also has 1,000 employees. So operational inefficiency. The operational expenses were high, as high in absolute terms as those of the nation's largest private bank. So not only that, the operating expenses were high in absolute terms as those of the nation's largest private bank. So the largest private bank expenditure is the same as Ceylon Bank, half of this size. Can you believe? Productivity gauged by assets per staff member and earnings per staff member were below the index. So the productivity is lost. High operational cost, less productivity. Profitability measured both by return on assets and return on shareholders funds fell significantly below the industry norms and below the returns posted by competing banks. So it was below the industry and competing bank. In pointing out these warning signs, the industry experts drew some general conclusions about management effectiveness at Ceylon Bank. Clearly, there was reason to question the quality of credit appraisals in the bank's lending and other financing activities. Poor credit appraisals. Risk management practices likewise fell short of reasonable standards. Risk management was fairly poor, and the bank was significantly overstaffed, demonstrating a lack of adequate human resource policies and procedures. Okay. So, improper governance. Equally apparent to outside analysts were more specific problems in one crucial aspect of the bank's business conduct: its relationship to the Cyclical group, whose principal shareholder and chairman was the Ceylon Bank's chairman, Dr. Kothala. You see, group exposure, group lending. That again led to the problems. Remember, we looked at governance-related issues and also dominant KMPs and chairmans and so on. Equally apparent to the outside analysts were more specific problems in one crucial aspect of bank's business conduct. It's okay. This is what we discussed earlier. So you see how it was important to have a fair dealings with the related group party. The Cyclical connection. The Ceylon Bank had taken on excessive and unjustified lending exposures with regard to many companies within the group. Group's exposure. Remember we discussed the governance failings? High exposure to related parties, I clearly indicated. Remember governance issues. This is not only here, anywhere in the world. Had signed contracts deemed unfavorable to the bank's own interest in order to obtain services from or deliver service to a large number. So at the expense of bank interest, contracts have been signed to provide better facility to the group companies. You see? So the bank has rather created benefit to the group, not to the bank. Okay. So at the end, what happened? Bank was about to collapse in late 2008. Significant rush in the bank. Liquidity went short of. The central bank had to intervene very fast to revive the bank. And bank was revived after the intervention of central bank with new shareholders coming, putting money, and boards were changed, existing boards were removed, and bank was able to revive within a very short period of time. Otherwise, it would have ended up with a significant systemic crisis in the entire banking sector. So this is a classic example of poor risk management, poor governance structures related to the domestic bank. Okay, so which I wanted to brought in at the last, because we discussed many cases happened in overseas, but this is a classic bank case. Of course, everybody knows what happened. So please read the book. I just took some summary points from the book. Expressed there, not my words, my thoughts, my ideas. This is what I extracted from the book. So read it, then you will understand real problems that it had. All are things related to our risk management discussion, risk governance. Okay, so if you look at the failure. But anyway, we were lucky to revive that company before it is being again highlighted as a failed institution. So corporate governance is a dynamic process and is continually evolving, and it has no boundaries for it. So it's a subject which is not static. Whatever the issues you had some time back may not be the issues you face right now and in future. So you have to address them as and when they arise, or when you see certain things happen, you have to address. So it's a dynamic process. It's not static and continually evolving. No boundaries or limits. So with that, I think we can finish our session for the day and also for the course. So any questions you have? Anything you need to clarify from last session? No, nothing. Good. Everybody is thorough with what we discussed. Only thing is to sit for the exam. Very good. So if we don't have anything, we'll stop for the day. If you have anything to clarify. But remember, the IBSL will announce your examination date soon, probably during the next class. Be ready. Now itself be ready with whatever things we discussed, myself and other resource person. So the exam could be conducted any moment of time. So be ready with whatever things we discussed. If you have any clarification, we have next week session just for the revision, and also I will bring some possible real world examples of risk management, how they are reported, and also do some revision to whatever the things I discussed with you all. So you can ask any questions from that area before we conclude the program next week. So we have few minutes here if you have anything.
So one thing I want to clarify that this is not relevant to today's topic, and I want to know how to develop a risk appetite framework for an organization.
Okay. Now, risk appetite is depend on your bank's different elements. Okay. Now, it depends on the size of the entity. Okay, size of the entity, the capital you have in place, and there are other many other factors, but broadly the size, the capital, because if you look at now, take example of now risk appetite means it could be to different aspects. Now it could be related to credit, it could be related to market, it could be related to the liquidity, and so on. So there may be different levels of risk appetite for different, the different aspects of the business. Now, when you take lending, I want to just give an example now. Now, lending, there are external risk guidance based already. Now, for example, with respect to lending, the concentrations, there are limits such as single borrower limits, and also counterparty limits and so on. So these are regulatory limits. Now, in addition, now you can build your framework based on the ability. Now I can't tell this is the, now let's say you are in bank A, this is what you should have. Now it's like a risk appetite is a certain set of limits parameters you set in. Now, for example, now based on your strength, now can I I can link into a general example now. Same way like so I am going in the road or highway. So depending on my vehicle, my strengths, my ability, I set my limit. You know, this is the limit this is the speed I drive my vehicle. You know, so it is something known to me, which someone else doesn't know. So I know I am moving in a, let's say, a new Mercedes Benz. You know, we have a lot of sophistication, a lot of new brake system, you know, good tire system, everything, you know. So I know I can go at this speed. So I set my limit as, let's say, 90. So that is my risk appetite, risk tolerance level. So I am not going to move beyond that. So that is my limit. So that's based on my experience and different parameters. Now I said my brake level, my tire conditions, my vehicle sophistication, and so on. Okay. Now similarly, somebody else, and also my driving capacity. That is my risk expertise. Okay. So let's say another person with in the same car may not have the same limit because his expertise may be different, because he can't his mental condition in such a way he can't face such a risk. Even his vehicle is same as my vehicle, so he may set a limit of 80. So here similarly, now just example credit risk. So you based on your capital strength, based on your expertise in the risk management, based on your other factors, based on the geographic location you are in, okay, then based on the country which you operate, okay, you take all those factors into account and you set a framework. Okay, now, okay, I will not, my maximum lending per person is this much. So this is my risk appetite level. Based on, let's say, capital, even the regulator give a higher level, you may decide, okay, I will give this. The maximum limit for this particular group of customers. Now, for example, let's say concentration, tourism industry this much, fisheries industry this much, import industry. So based on your judgment, your experience, you build up some framework, okay, which is not the same as another bank. Okay, so that I'm just giving an example of credit, and also you can select the customers, your risk appetite. So I will only cater to these sectors. Another bank will cater to 5 sectors, but you will cater to another only 3 sectors. So your appetite is limited to those sectors. So you set a benchmark. Okay, I will never, now that's why some bank they never give loan to some, even at a higher interest rate, they will never give to certain loans to certain parties. Now, for example, I will never give a loan to a BB below rated corporate. So that's my risk appetite. So I always encourage in my policy to give a loan to a BBB, sorry, above BB. So I will not give loan to a BB or below rated customer. So based on your experience, based on your capacity, you set some, benchmarks, quantitative and qualitative. So that is acceptable for your business. as per your resources. The appetite is based on your resources. Because when doing business, you are faced with different risks, credit, market, liquidity. So then to mitigate those risks, you have resources. So what are the resources? Capital, management, earnings, and so on. So you will focus all those risks in relation to your resources and set up the framework, which is my risk tolerance appetite level. So that's the individual judgment. There is nothing written saying, okay, these are the things you should look at. So it's an individual judgment. Now, for example, now if you take now trading, now take trading limits on treasury operations. Now different banks have different trading limits, different counterparty limits. So this is my risk appetite. So I will, when I trade with another counterparty, maybe another country or counterparty, this is the limit I always adopt. Maybe based on the rating. So that is your risk appetite. Now, two banks have different level. Now, say even you may not lend to a BB below customer, another bank will lend. Because here, their risk appetite may be different based on valid reasons. So it's an individual judgment based on many factors, availability of resources, and your past experience with respect to certain maybe transactions or maybe losses. You set some benchmark. Of course, that is not again static. As you go on, you may change your risk appetite based on your real experience. Anything else?
Thank you, sir. One more thing I want to clear that several times we discuss about severe stress economic scenario. In that case, how do we define the severe stress economic scenario based on that GDP growth rate, or is there any indicators?
No, the severe stress is now already, you don't have to decide because now if you look at the Basel 3, there are two things. One is capital components. Now the new capital components are structured in such a way, even a significant stress scenario arises, you are capable of managing the capital. Okay, now you don't have to define it. So you are not defining anything, and you get ready. Now, so now when you keep now in Sri Lanka, there is a maybe number you want to keep. Now if Basel, you need 4.5% capital, common equity tier 1 capital, and 2.5% capital conservation buffer. So that means both together you need 7%. So what does it mean is when you maintain it, now you are required to maintain it. So when you maintain it, even a significant stress scenario means now any bank in day-to-day business may be subject to different stresses, but those will not result in a significant crisis. But significant stress scenario means you cannot control it. It is beyond your control, which is not expected. Now, the risks are, there are two risk events, expected and unexpected. Now, when you give a loan, you expect certain, for example, there could be a default. So that is, so you keep a margin for that, for the credit risk. There's a risk premium when you price it. But that is something based on your experience, expected risk. Okay, expected failure, expected expected default. But there may be a scenario, for example, you give a loan to a AAA customer. So AAA customers risk premium is, let's say, 1%, then you price it the loan based on that 1%. But even a AAA customer may default suddenly without, you never expected this good customer default suddenly due to whatever reason. So to cover up unexpected loss also, a bank can keep a little bit margin. Okay. So similarly here, when you keep a conservation buffer, that is basically for a stress scenario. So you don't have to worry about whether stress come or not. You already ready with the buffer. But in the case of counter-cyclical buffer, now counter-cyclical buffer is something that the regulators introduce at a time of excessive credit growth. So when your regulator see the economy, the banking system is, the credit is very high growth, credit growth is significantly high, there is a possible risk subsequently, then of course counter-cyclical buffer would be defined. So bank need not define it, it's the regulator define what is excessive credit growth and regulator impose counter-cyclical buffer. So basically, you don't have to decide what is excessive stress scenario. What the Basel says is the new capital ratios are formed such a way, even in a stress scenario, you should be able to manage it. Even liquidity is like that. Now, if you take liquidity, there is already a ratio called statutory liquid asset ratio. That is the liquidity, something you maintain to meet day-to-day liquidity requirements. But the Basel III says you need to maintain LCR and NSFR if there is a stress scenario. So now itself, if you maintain those two, you are ready to face a stress scenario. A stress scenario is something unexpected, beyond the expected risk. Now, risk is two things: expected loss and unexpected loss. So the basically stress scenario is significant than normal. How do you maintain? So individual bank need not decide what is stress scenario. When you maintain these capital ratios and new liquidity ratios, you even if it's stress scenario arise, you can face it. Okay.
Okay, thank you, sir. So another question, in our capital adequacy computation under the credit risk parameters, it's given under claims secured by gold.
Okay.
Under that 833, it says gold loans to value ratio equals or over 100%. The risk weight is only 100%.
Yeah.
So why is that, sir? That normally when the value is exceed 100%, risk should be more than that, no?
No, there are no. I mean, there is no. I can't say exactly what is the reason, but now, for example, now you take not just that. Now, if you take now, I'll give example of corporate lending. Now, corporate lending, you see now, if you look at now, take example of corporate lending. Now, claims on corporates. Now, if you look at corporate lending also, this is how the original Basel was structured. Now you look at double B minus below, risk weight is 150%. But if there is no rating, 100%. You see? So from the bank's point of view, it is better to give a loan to unrated entity in terms of maintaining capital rather than give it to a BB minus below rated entity. Can you see that if you have a double B minus below rating, you will be required to give 150% of the exposure. Capital amount to 150, but unrated 100%. So, so there are certain maybe maybe the Basel when they consider now. I mean, 100% is fairly a good number because loan to value ratio is 100% means anyway you are covering your total exposure. It is 100% risk weighted. I mean, loan to value ratio equal above 100% doesn't mean you are covering a lesser figure, but your total amount is 100% risk weighted. Now, let's say your that security value is 100. Okay, security value is 100. You are giving a loan of 110. Okay, loan amount is 110, but the value is 100. Okay, so that is what you are talking, loan to value ratio equal low over 100. But for the risk weight, you have to keep 100% capital for that 110. So the risk weighted asset value is 110. Okay, so what you say is you want to have more than 110 also. Okay, so basically you need to cover entire exposure. It's not less. Now, if you look at loan to value ratio less than 70, your risk weight is 20. Now, in such a case, even though your loan is 100, you keep only capital for 20. But here, if your loan to value ratio is over 100, you need to keep capital for entire amount. So basically, you are covering your exposure. There is no problem in it. No? You need to keep. Now here you are covering only 20%. Now it's like this, no? Now your article is 100 value. Okay. So your loan is 70. Loan is 70. Okay, loan is 70. Now what do you mean by that? Let's take example. If your loan is 70, article value is 100, then how much risk weight apply? How much risk weight apply? Your article value is 100, your loan is 70, then how much the risk weight it applies?
It's 0%.
Sorry, 70 means over 70, let's say over 70.
Over 70, it's 20%. That means 20.
20% means you will keep capital only for how much? Now forget about this margin, let's say 75. Let's say 75. Your loan value is 75. Article value is 100. Okay. So how much the risk weight is? 20. So how much your risk weighted asset value?
That is 20% of 75.
20% of 75. 20% of 75. That means 50. So you will need to keep capital only for 15 million, even though your loan is 75 million. Your loan is how much? 75 million. Your loan is 75 million, but you need to maintain capital only for how much? 15 million. Let's say capital adequacy ratio, let's say 10%, for example. So how much capital you need to maintain? Only 1.5 million. 10% of 15. So if you are giving a loan of 75 million for an asset worth 100 million, okay, you only need to keep how much? 1.5 million. Now you are only giving additional 25 million. Let's say your loan is 100 million. Then your loan, how much capital you need to maintain? Risk-weighted asset value, how much? Risk-weighted asset value, how much?
If the loan is 100, then the 100% risk-weighted, then the risk-weighted asset also 100.
100. So let's say if the capital is 10%, how much you need to maintain?
It is only 10.
10 million. So you compare. Now your exposure is went up by only 25 million. Your capital, how many times you have to impose now? Earlier case, only 1.5 million. Now you have to keep 10 million. So it's barely covered the risk, no?
Yes.
Okay. So now if you look at these certain numbers, you cannot say exactly what is the rationale, but these are the numbers Basel came up. Based on their experience, maybe suggestions, but probably we would have followed somewhat in line with Basel, but there may be certain modifications. But there are some issues, like I mentioned now, corporates, if it is unrated 100%, but if it is rated below BB minus, it is 150%. So there are certain issues, but other than that, fairly okay. So these numbers basically given numbers by the Basel, sometimes the regulators have made slight modification in their respective countries. Now, for example, I think in retail exposures, I think Basel said even 35%, but here in Sri Lanka, I think we have 75% for the retail, certain retail exposures. Okay. Any more questions? Okay. No? Okay. If you don't have anything, we'll stop for the day. But of course, next week, if you have some other questions, you can bring those. We will discuss those as well. And we can do a very brief revision on the areas which I completed, so that you can ask questions related to other areas as well. So with that, we'll stop for the day. Thank you.